If 100 traders trade the exact same strategy, they'll all end up with completely different results. Some will make a fortune, most will fail, and a few will just break even. How is that even possible? I'm about to show you a real experiment that proves this point, and by the end of this video, you'll never look at trading strategies the same way again. Because trading isn't just about the strategy. It's about the execution, the discipline, risk management, and the psychology behind every single click of the mouse. Today I'm going to break down exactly why strategy is only half the story, and why your unique approach matters more than you think. Plus I'm going to share a story about my own dad's personal experience trading with an option signals group that I think is going to blow your mind. But first, let me paint you a picture. When most new traders discover a strategy, whether it's a moving average crossover, a candlestick pattern, or a breakout setup, they believe the hard work is over. If I just follow these rules, I'll make money, like the person who taught me. That's the biggest illusion in trading. Here's the real example. There's a popular YouTuber who teaches smart money concepts. Seems foolproof, right? Smart money concepts, right? But if you look through comments on him, you'll see plenty of people saying, "This changed my life. Finally, a strategy that actually works." But if you dig deeper, you'll find just as many, if not more, people saying, "I tried this for 3 months and I lost money," or "It worked for a week and then it stopped working." Same strategy, same teacher, completely different results. Take 100 traders, give them the same rules, put them in separate rooms, and you're going to see 100 different outcomes. Why? Because no two traders interpret or execute a strategy in the exact same way, even when they think they are. One person might jump in early because they're scared of missing the move, another might be waiting too long for the perfect confirmation and just miss the trade entirely, and someone else follows the rules perfectly but then bails out the second they see a red candle because their risk tolerance is just different. The result, completely different trades from the same supposed system. And here's where it gets really interesting. Let's get practical with a scenario I witnessed in a trading room. The strategy was a simple breakout trade. The rules were crystal clear. Buy when the price breaks above resistance with volume, set a stop loss just below the breakout level, take profits at 2 times the risk. Only trade this setup on stocks above $20 with an average volume over 100 million shares per day. Sounds pretty bulletproof, right? But here's what actually happened when a setup appeared on Apple. Let's call the first one Trader A. Trader A enters immediately on the breakout at $150.25. Trader B wanted to wait for a retest of the breakout level for confirmation and never got filled because the stock just kept running. Trader C loved the setup so much he sized up to 10% of his account instead of his usual 2% because this one looks perfect. Trader D got his entry, but then he got nervous when the stock pulled back 50 cents and closed early, missing the entire $4 run. Trader E followed the plan exactly. Entered at 150.25, stop at 149.75, target at 151.25, and was the only one who captured the move. Same rules, same chat room, same exact setup, 5 completely different results. And this happens every single day in every trading community across the world. But wait, it gets even more psychological. This is where things get really fascinating to me. Every trader brings their own personality into the market, and most don't even realize it. Some are naturally risk averse, they're the ones who've been burned before. Some are thrill seekers who get hooked on trading because of the adrenaline rush, and some freeze under pressure like a deer in headlights. Others can't stop clicking the buy button because they have FOMO on every setup. This psychology seeps into every trade, whether you notice it or not. Let me give you some real examples from traders I've observed over my 6.5 years now of trading pretty much every week. The perfectionist waits for the perfect setup, misses 80% of good trades because nothing ever looks perfect in real time. The impatient trader cuts winners too soon because they can't handle the stress of watching unrealized profits disappear. The stubborn trader refuses to stop out because the analysis was right and turns small losses into account killers. The stubborn trader is not around very long. The gambler also won't be around very long, but probably comes back once he makes a few more dollars, oversizes positions because this one feels different, and blows up on what should have been a routine trade. The fearful trader analyzes everything perfectly but never actually enters the trade because they're paralyzed by the what-if scenarios. Here's the kicker. A strategy doesn't erase those tendencies. In fact, it actually exposes them. That's why two traders can use the same signals but create totally different equity curves. And speaking of opposite results, let me tell you about risk management. Even if two traders enter the same trade at the same price with the same exact stop, their outcomes can be miles apart. The reason? Risk management and position sizing. Here's a real example that'll make it very clear. Two traders take the same breakout trade on Tesla, $200. Both set their stop loss at $195. Both have a target of $210. Identical setup. You're looking to make 10, risking 5. Trader 1 has a $100,000 account and risks 1% per trade. So he buys 20 shares, $1,000 risk. Trader 2, same $100,000 account, but he risks 5% per trade. So he buys 1,000 shares and risks $5,000. The trade hits the stop. Both lose. Trader 1 loses $1,000, 1% of his account, and Trader 2 loses $5,000, which is 5% of his account. Now imagine this happens 3 times in a row. Totally normal in trading. I've actually had a loss streak of 9 in a row last year. Trader 1 is down 3% and can easily recover. Trader 2 is down 15 and needs a 17.6% gain just to get back to break even. The same strategy, the same entries, the same stops, completely different outcomes. One could continue trading, one could blow up the account if the streak continues. But here's what really separates winners from losers. The winners understand that risk management isn't just about position sizing. I know traders who've had 8 losing trades in a row using a profitable strategy, but because they managed their risk properly, they were only down 4% for the month. Meanwhile, others hit 3 losers and were down 20% because of how they sized. Risk management is the invisible hand that makes or breaks traders, and it's the biggest reason why copying a strategy never guarantees the same results. Here's another factor that most traders completely ignore: market conditions. The same strategy that absolutely crushes in a trending market might get chopped to pieces in a sideways market, and most traders don't adjust. They just keep running the same plays regardless of the environment. Let me explain what I mean. A breakout strategy, that's what I trade. Fantastic. When the market is strong, upward trending or downward trending, the momentum is working, you're getting clean moves, the follow through, the runners, they go on for days. It's really good for swing trading. But try that same strategy when the market is choppy or range bound. You'll get fake out after fake out after fake out. I have absolutely been there. Just last year, I had a period of time where my strategy would operate at 60+% win rates. Then I'd have periods of time where it would operate at around 20 to 30% win rates. I even had a month where it was actually sub 20%. Now picture 100 traders, all running the same breakout setup for a 6-month period. The ones who recognize when market conditions aren't favorable for their strategy, they'll step back, they'll preserve their capital and wait for better opportunities. And the ones who stubbornly keep trading the same signals regardless of the context will slowly bleed out their accounts. Here's what the smart traders do. They track their strategy performance in different market environments. They know when to press and when to back off based off past experience. They understand that no strategy works in all of these conditions. And the traders who don't adapt, they're the ones posting in Facebook groups asking, why did this strategy stop working? Not realizing the strategy didn't stop working, the market conditions just changed. This brings me to something that a lot of new traders fall into: copy trading and signal groups. The idea sounds incredible on paper. Follow the trades of a successful trader, copy their entries and exits, and profit without doing any of the heavy lifting or having to deal with the learning curve. But here's the brutal reality. Even copy trading isn't truly copy trading. First, there's the execution problem. By the time you get the alert, process the information and place the order, the price has already moved, and your fill is definitely going to be different from the leader's fill. Maybe they got in at $50 and maybe you got filled at $50.15. That small difference compounds over time. Then there's the position sizing issue. They might risk 2% per trade with a $500,000 account, and you might have a $10,000 account and think, I'll just risk the same dollar amount, not realizing you're now risking 20% per trade instead of 2%. But here's the biggest problem. Your emotions are not their emotions. When the leader holds through a 20% drawdown because they've backtested the strategy and know how it recovers, are you holding? Or are you panicking, closing everything because you can't handle watching your account drop by that much? When they add to a winning position because it's part of their system, do you have the capital and the conviction to add? Or are you already fully invested because you went too big on the first entry? Let me tell you a personal story about my dad that perfectly illustrates this. But first, let's thank the sponsor of today's video, Iron Beam.
Welcome to Iron Beam, the future of futures trading. With our cutting-edge chart trading feature and 300+ indicators, you can now trade directly off the chart anytime, anywhere. Delivering seamless trading across all platforms, the Iron Beam journey is supported by 24-hour trader support, low day trade margins, and no account minimums. Iron Beam brings the future into the present. Join now and augment your trading experience.
My dad joined an option signals group a couple of years ago, and to my understanding, he's doing okay. But here's the thing. The service would send out alerts, my dad would try to copy them, and he would always be just slightly off. Sometimes he would miss the entry by a few minutes because he didn't get the notification in time. Sometimes his broker would be a bit clunky and it would take time to enter the order, so he'd get in 5, 6, 7 minutes late. And sometimes he'd even just miss alerts. Other times he would size smaller or even larger than normal because he's rushing to get in the trade and he doesn't want to get a bad fill because inevitably when a lot of people are trading the exact same contracts, well, the spreads are going to move and you're not going to get what the alert said to get in at. To top it off, people will always ask on the live streams and then the live tradings about the stock of their choice. Well, what do you think about Tesla? Well, what do you think about Apple? Will he be trading Apple or Tesla? I don't know. He probably won't. However, he'll say, oh, that looks pretty good. You could probably buy some 200 calls on Apple. And what ends up happening is a lot of the people in the group take that as gospel. They take the trade, whether it works or doesn't. It now completely throws you off from what he's actually generating for the signals group. So while in 1 year he might be up 34%, you could actually be down despite taking a lot of what you thought were the same trades. The lesson is that you can't outsource conviction. You can borrow signals, but you can't borrow discipline, risk tolerance, or emotional control. So what does this all mean for you as a trader? It means that the strategy is just the starting point. It's like having a map, but having a map that doesn't guarantee you'll reach the destination. You still need to know how to read the map, navigate the obstacles, and make decisions along the way. The real differentiators are execution consistency. Do you follow the rules exactly the same way every single time, or do you get creative and start making exceptions? Risk management. Do you size positions properly based on your account size and risk tolerance? Do you know when to reduce size during drawdowns? Do you know when to increase size? Psychological control. Can you manage fear when you're down? Can you control greed when you're up? And can you maintain discipline when you hit a losing streak? Market adaptability. Can you recognize when market conditions don't favor your strategy? Do you know when to step back versus when to press forward? Personal fit. Does the strategy match your personality, your schedule, and risk tolerance? A day trading strategy won't work for someone who can't watch charts all day or won't have access to their phone. When you combine a solid strategy with those 5 elements, that's when consistency shows up. That's when you stop being at the mercy of random results and start building a real edge. Here's the beautiful part. Your trading will look different than anyone else's. That uniqueness isn't a bug. It's a feature. It's what makes markets function efficiently. For every buyer, there has to be a seller. And if we all traded identically, there would be no market at all. The goal isn't to become a carbon copy of another trader. The goal is to take proven concepts and adapt them to your own situation, your own personality, and your own goals. So next time you see a shiny new trading strategy on YouTube or a guru promising you just to follow my signals and get rich, remember this video. 100 traders can follow the exact same strategy and end up with 100 different outcomes. The difference isn't the rules, it's the trader behind the rules. And that means your job isn't to find the perfect strategy that works for everyone. Your job is to find the strategy that works for you, your schedule, your risk tolerance, your personality, and your goals. Because when you do that, you stop chasing someone else's path and start building your own. You stop looking for the holy grail and start focusing on becoming a holy grail trader. And that's when trading transforms from gambling into a genuine edge-based business. The strategy is just the vehicle. You are the driver. And the best drivers don't follow the GPS blindly. They understand the roads, they anticipate the traffic, and make smart decisions along the way. If this helped change the way you think about strategies and trading, smash that subscribe button and stick around. This channel is all about breaking down the mental game and practical side of trading so you can stop chasing systems and start building actual skills. What is your experience following someone else's strategy? Drop a comment below. I'll read all of them. Thanks so much, guys. See you in the next one. Peace.